Most traders believe speed makes them sharper. They think faster charts give them more control, more opportunity, more precision. This belief feels logical on the surface. It is also one of the most expensive misunderstandings in trading. Speed does not improve judgment. It compresses it. The faster the chart, the less time the mind has to process information calmly. Decisions are made under pressure, not clarity. Each candle demands attention. Each tick feels meaningful. The trader is pulled into constant evaluation, constant adjustment, constant reaction. What feels like engagement is actually emotional overload. Skill requires space. Speed removes it. On fast charts, the nervous system stays activated. Heart rate rises, focus narrows. The trader becomes alert but not thoughtful. In this state, the brain prioritizes response over reasoning. Trades are taken to relieve tension, not because conditions are complete. This is why fast charts are addictive. They create a loop of stimulus and response. Movement triggers emotion. Emotion triggers action. Action creates temporary relief. That relief fades and the cycle repeats. Over time, trading becomes a way to manage internal pressure rather than external risk. Professionals recognize this danger. They understand that skill is not the ability to react quickly. It is the ability to wait without discomfort. Faster charts reward those who enjoy stimulation, not those who respect probability. They magnify fear, impatience, and ego. Every weakness becomes louder. Fear exits early. Ego enters early. Impatience enters often. The trader believes they are making more decisions. In reality, they are losing control over the quality of those decisions. Too many inputs overwhelm discipline. Too many decision points drain mental energy. Eventually, rules blur, execution slips, and confidence collapses. This is not because the trader is incapable. It is because the environment is hostile to discipline. Skill in trading is consistency of behavior under uncertainty. That consistency cannot exist when decisions are rushed. The faster the chart, the more likely the trader is to negotiate rules, justify impulse, and act before confirmation. Fast charts make traders feel involved. They do not make them accurate. Professionals choose environments that protect discipline. They understand that fewer decisions lead to better decisions. When time is stretched, emotional spikes flatten. The trader has room to think, to evaluate context, to accept risk before entry instead of during it. This does not eliminate losses. It eliminates unnecessary ones. Losses on fast charts hurt more because they often come from emotional entries. The trader knows deep down that the trade was rushed, that knowledge damages self-trust. Once self-trust is gone, execution deteriorates rapidly. Professionals fear this more than losing money. They know money can be recovered. Discipline is harder to rebuild. Fast charts give the illusion of control. The trader feels powerful, active, alert. But control in trading is not about speed. It is about restraint. It is about knowing when not to act. Faster charts make restraint difficult because they constantly demand attention. The market does not demand that attention. The trader's mind does. When traders slow down, something uncomfortable happens. They feel boredom. Feel irrelevant. They feel like they are missing out. These feelings are not signals, they are withdrawal symptoms from stimulation-based trading. Professionals endure this discomfort. They accept that most movement is meaningless. They accept that opportunity is rare. They accept that missing trades is part of survival. By doing so, they remove emotional urgency from decision-making. This is where real skill develops. Skill is not clicking faster. Skill is waiting longer. The trader who escapes fast charts does not become passive. They become selective. Each trade carries weight. Each decision is intentional. Losses are taken with clarity instead of confusion. Wins are not celebrated emotionally because execution mattered more than outcome. Faster charts expose who you are before discipline is built. Slower, structured environments shape who you become after it is built. Professionals understand this distinction and choose accordingly. Speed magnifies impulse. Time magnifies control, and control is the only skill that survives the market. The market moves far more than it needs to. Candles form, Bria. K, reverse, stall and surge throughout the day, creating the illusion that something important is always happening. Most traders fall into this illusion early. They see movement and assume opportunity. They see volatility and assume urgency. What they are really seeing is a test. The market is constantly testing impatience. Price does not move to help you make money. It moves because participants act with different intentions, time horizons, and emotions. Much of this activity has no directional meaning. It is noise created by fear, hedging, speculation, and short-term imbalance. This noise is not accidental. It is the environment in which discipline is either strengthened or destroyed. Impatient traders interpret noise as invitation. They feel pressure when price moves without them. They feel anxiety when candles form quickly. They feel discomfort when nothing aligns. That discomfort becomes the reason to act. Trades are taken not because conditions are clear, but because waiting feels intolerable. This is how impatience disguises itself as initiative. Professionals understand that most price movement has no obligation to reward participation. They expect false starts, shallow breakouts, and meaningless fluctuations. They do not treat these as failures of the market. They treat them as filters. Noise keeps them out of trades that do not deserve risk. Impatience pushes traders into those trades. The impatient mind does not wait for confirmation. It anticipates it. It tries tea. Oh, be early. Believing early means smart. In reality, early often means exposed. The market has not yet revealed intention, but the trader has already committed capital and emotion. When the trade fails, frustration follows. When frustration repeats, discipline erodes. This erosion is subtle. It happens trade by trade, decision by decision. The trader begins to doubt rules. They widen stops. They reduce patience. They take trades more frequently to make up for time wasted waiting. Each step feels reasonable in isolation. Together, they create inconsistency. Professionals refuse this cycle. They accept that waiting is part of execution. Waiting is not empty time. It is active discipline. It is the decision to do nothing while the market sorts itself out. This decision is difficult because it offers no immediate reward. There is no dopamine, no sense of progress, no validation, only restraint. The market exploits those who cannot endure restraint. It accelerates, reverses, and hesitates specifically where impatience is most uncomfortable. This is not intentional in a personal sense, but it is structural. Those who cannot wait provide liquidity. Those who can wait, take it. This is why patience is not a personality trait in trading. It is a skill built through repetition and discomfort. Each time a trader watches price move without acting, patience strengthens. Each time they ignore a weak setup, impatience weakens. Over time, the trader stops feeling pressure from noise. They see it for what it is. Professionals do not feel compelled to trade during noise. They feel protected by it. Noise allows them to conserve capital and mental energy. It reduces emotional fatigue. It limits the number of decisions they must make. Fewer decisions mean higher quality execution when real opportunity finally appears. Real opportunity is quiet at first. It does not demand immediate action. It develops through structure, time, and confirmation. Impatient traders miss it because they are exhausted by the time it arrives. Professionals are ready because they have done nothing when nothing was required. This readiness is the edge. Most traders believe impatience costs them money. In reality, impatience costs them clarity. Once clarity is gone, execution becomes emotional. Once execution becomes emotional, consistency disappears. The market does not punish impatience all at once. It drains it slowly, through small losses, missed exits, and poor decisions made under pressure. Professionals see this pattern early and adjust. They stop fighting movement. They stop demanding action from every candle. They stop confusing motion with meaning. By doing so, they remove the market's ability to rush them. The market cannot hurry a disciplined trader. When impatience is mastered, price movement loses its power to provoke. The trader no longer feels tested by noise. They feel informed by its absence. And that shift changes everything about how they trade, how they wait, and how they survive. Most traders believe discipline comes from willpower. They think if they just try harder, focus more, or stay motivated, their behavior will improve. This belief fails the moment the market becomes active. Willpower collapses under constant decision-making. Discipline does not break because the trader is weak. It breaks because it is overused. Every decision costs something. Each chart you check, each candle you analyze, each possible setup you consider drains mental energy. The more frequently you are forced to decide, the faster discipline erodes. By the time a real opportunity appears, the trader is already tired, already emotional, already compromised. This is why overtrading is so common. High decision frequency creates the illusion of control. The trader feels busy, involved, and alert, but beneath that activity, discipline is quietly bleeding away. Rules become flexible, patience shortens, risk tolerance shifts. What once felt unacceptable starts to feel reasonable. Professionals understand this early. They know discipline is not unlimited. It must be protected. The simplest way to protect it is to reduce how often decisions are required. Fewer decisions mean more clarity. More clarity means better execution. This is not laziness. It is strategic restraint. When decision frequency is high, the trader reacts instead of executes. Reaction feels fast and confident in the moment, but it is rarely grounded in context. Execution, on the other hand, requires calm cannot exist when the mind is constantly evaluating, adjusting, and second-guessing. Reducing decisions restores calm. Professionals design their trading to limit interference. They choose environments that do not demand constant attention. They use time to filter opportunity. They accept that most moments do not require action. This acceptance is not passive. It is deliberate. Every ignored trade preserves discipline. Every unnecessary trade spends it. The struggling trader does the opposite. They expose themselves to non-stop decision-making. They monitor every fluctuation. They treat each movement as a potential threat or opportunity. Eventually, discipline becomes exhausted, and emotional behavior takes over. This is when rules are broken, not because the trader forgot them, but because the trader no longer has the mental capacity to enforce them. Discipline under fatigue is fragile. The market does not need to defeat the trader. It only needs to wait until the trader defeats themselves. Professionals avoid this trap by trading less, not more. They understand that consistency is not built by frequent participation. It is built by consistent behavior. Consistent behavior requires energy, clarity, and emotional stability. All three are destroyed by excessive decision-making. Reducing decision frequency also changes the trader's relationship with time. They stop feeling rushed. They stop feeling behind. They stop feeling pressured to act. This removes urgency and, urgency is the enemy of discipline. Urgency creates mistakes. Patience prevents them. When decisions are rare, they matter. Each trade carries weight. Each entry is intentional. Each loss is accepted without panic because it was planned in a calm state, not rushed into under pressure. Professionals do not rely on discipline to survive chaos. They design their process to avoid chaos altogether. By reducing how often decisions are required, they protect the very skill most traders lose first. Discipline does not need to be heroic. It needs to be preserved, and preservation begins by doing less. Most traders are not destroyed by losses. They are destroyed by how losses arrive. A loss taken with structure is tolerable. A loss taken without structure feels violent. The difference is not the amount lost, but the state of mind in which the loss was accepted. When time and risk are respected, losses are anticipated. When they are ignored, losses become shocks. Shock is what breaks discipline. Time is the first layer of protection. When trades are rushed, there is no space to prepare mentally. The trader enters under pressure, driven by urgency or fear of missing out. Risk is accepted emotionally, not logically. When price moves against the position, the trader reacts instead of executing. Stops are moved, rules are negotiated, losses expand. This is not bad luck. It is poor respect for time. Respecting time means allowing setups to form fully. It means waiting for confirmation instead of anticipating it. It means accepting that opportunity does not disappear because you waited. Time filters impulsive decisions and exposes weak ones. Risk is the second layer. Risk respected is risk defined. The trader knows exactly how much they are willing to lose and why. This acceptance happens before entry, not during the trade. Once the position is live, there is nothing left to negotiate. Professionals do not argue with losses. They planned for them. When time and risk are aligned, losses lose their emotional sting. They are expected outcomes within a larger process. The trader does not feel attacked by the market. They do not feel the urge to revenge trade. They do not question their identity. This emotional stability is not natural. It is built. Traders who ignore time and risk often believe they are being flexible. In reality, they are being reactive. Flexibility belongs in strategy development, not in execution. Once execution begins, discipline must be absolute. The market will test this discipline aggressively. It will hover near stops. It will hesitate near targets. It will create doubt when patience is thin. These moments are designed to expose whether the trader respects their plan or negotiates it. Professionals choose respect over hope. They respect time by not forcing entries. They respect risk by not expanding losses. They understand that survival depends more on loss control than on win frequency. A trader who survives long enough learns. A trader who does not is removed. Losses taken without time and risk damage confidence because the trader knows the process was violated. Losses taken with respect reinforce trust because discipline was preserved. This trust is more valuable than any single trade. The market does not reward courage. It rewards control. Control over entry timing. Control over risk. Control over behavior when price moves against you. When this control is present, losses remain small, contained, and recoverable. Professionals do not fear losing trades. They fear losing structure. When structure remains intact, losses become manageable events, not emotional disasters. And that stability is what allows consistency to develop over time.